You're about to join into the world of systematic market cycles. Learn the most dependable and consistent, yet often overlooked investment strategy. Welcome to the Technical Intrinsic Value Podcast.
We spend pretty much our entire lives just unconsciously relying on the physical laws of the universe.
Right.
And gravity is like the ultimate baseline, right? You drop an object, it falls.
Exactly. The default state is down.
Yeah, a downward pull. It's entirely predictable, and that predictability forms the whole foundation of how we interact with the world.
Yeah.
But the moment you transition from the physical world into the mechanics of long-term financial markets,
that whole logic just gets completely inverted.
right, it's completely flipped. The default state of the financial market isn't a downward pull.
No, it's this systemic, relentless upward momentum.
Which is so hard to grasp.
It is arguably the single most difficult psychological hurdle for anyone trying to navigate equity markets. Because our brains are simply not hardwired to anticipate a perpetual upward float,
Right, we naturally look for the ceiling.
Exactly. We naturally anticipate the fall.
And that tension between what our brains expect and how the market actually functions, that's the foundation of our conversation today. So welcome to this deep dive.
Glad to be here.
We have an incredibly robust foundation for today's analysis, as we are officially welcoming the Technical Intrinsic Value Podcast and its comprehensive source materials to the table.
It's going to be a fascinating one.
Oh, absolutely. And as we get into the complex mechanics of market cycles today, I want to establish right at the top that the analytical frameworks, the specific mathematical models, and all the proprietary data we are exploring belong entirely to Niccolò Primavera Carvalho.
Right, the author and creator of the Technical Intrinsic Value Model.
Exactly, which we will be referring to as the TIV model throughout the discussion. We're just here to objectively report on his methodologies and share the insights from his work.
And honestly, the timing for unpacking Carvalho's work, specifically his piece titled The Geometry of Loss, a comprehensive analysis of short-selling risks, it really couldn't be more critical.
No, it really couldn't. If you're listening right now, maybe you're managing your own portfolio and you're feeling that visceral pressure of late-cycle market euphoria.
Oh, yeah. That overwhelming sensation that valuations have entirely detached from reality.
Right. And you feel like you need to aggressively bet against them.
Mm-hmm.
Well, the math we're going to look at today might actually save your portfolio.
It really might. The mission here is to strip away the emotion of trading, We need to look strictly at the operational and mathematical realities of short selling versus capital preservation.
Okay, let's unpack this. Let's start by challenging that literal instinct to bet against the market.
Because it's a strong instinct.
It is. For anyone who has studied market history, or frankly, anyone who lived through the 2008 financial crisis, there is this ingrained trauma.
Oh, definitely.
2008 felt like gravity suddenly reasserting itself on the market. It felt chaotic, random, and just terrifying.
Yeah, and it convinced an entire generation of retail investors that the market is inherently fragile.
Like it's just a house of cards waiting for the next catalyst to completely collapse.
Right. That 2008 trauma created a really pervasive culture of catastrophe hunting.
Everyone wants to be the genius who calls the top.
Exactly. Retail investors are constantly looking for the next big short. But Carvalho's TIV model approaches historical market data from a radically different perspective.
How so?
Well, when you strip away the frantic media narratives and look purely at the quantitative data, 2008 wasn't an unpredictable black swan,
Right.
Or a random failure of the system. It was actually a rhythmic, mathematically measurable, cyclical reset.
Meaning it was supposed to happen.
Exactly. The market operates in continuous waves. Accumulation, distribution, and exhaustion.
Which fundamentally changes how you view a market peak. If a crash isn't the market breaking, but rather the market breathing.
Like completing a cycle.
Right, completing a cycle. Then trying to short the market just because prices seem too high means you're stepping in front of a macroeconomic freight train.
A massive one. Let's look at the baseline numbers Carvalho uses to frame this.
Let's do it.
Since 1957, the S&P 500 has generated an average annual return of roughly 10.5%.
That's a huge systemic tailwind.
It is. The stock market is not a neutral playing field. Long and short positions do not have equal probability.
Because the underlying architecture human productivity, corporate earnings growth, inflation. It all creates a perpetual upward bias.
Exactly. Betting against that 10.5% historical gravity is the defining characteristic of a short position. You are inherently fighting the broader trajectory of capital accumulation.
And this is where Carvalho introduces the concept of the geometry of loss, right?
Yeah.
Mapping out the structural asymmetry of risk.
Yes, let's break that down for the novice investors listening because it's crucial.
So think of it like this. Taking a long position, just buying a regular stock, is like climbing a ladder. If you fall, you only fall to the ground.
Right, your risk parameters are finite. The absolute worst-case scenario is the company goes bankrupt, the stock goes to zero, and you suffer a 100% loss of your invested capital.
The floor is literally zero. You can't lose more than you put in. But the ceiling.
The ceiling is infinite. A long position can compound 200%, 500%, or 2,000% over a couple of decades. The math is structurally biased in your favor.
But the moment you initiate a short position, you flip that entire mathematical geometry upside down.
You really do.
The ceiling becomes the floor, and the floor disappears entirely. It's like digging a hole where the sky is the limit for how deep the dirt can bury you.
That's a great analogy. To understand the severity of that inverted math, we have to look under the hood of how a short position is actually constructed.
Okay, let's walk through the mechanics.
When you short, you are borrowing shares from a lender via your prime broker. You immediately sell those borrowed shares into the open market and you pocket the cash.
Right, and your obligation is to eventually buy those shares back, hopefully at a lower price, to return them to the lender.
Exactly. So if the stock goes to zero, you keep all the cash. But that represents a hard cap on your profit.
A maximum 100% return. And that's only if the company literally ceases to exist.
Right. And the risk side of that equation is where the infinite loss language comes into play.
Because there is theoretically no limit to how high a stock price can rise.
Precisely. There is no limit to how much it will cost you to buy those shares back. If you short a stock at $100 and it rockets to $500, you are on the hook for that entire spread.
But the theoretical infinite loss isn't even the most immediate danger, is it?
No, it's not. The immediate practical danger is the margin requirement.
Right, the margin call. Let's talk about that.
The margin mechanics act as an operational tripwire. Under standard Regulation T rules, your broker requires you to maintain a specific percentage of the trade's value as collateral in your account.
Usually around 50% for initial margin, right?
Exactly. So if you short $100,000 worth of stock, you must lock up $50,000 of your own cash as collateral.
Okay, let's run a hypothetical stress test on that $50,000 collateral for the listeners. Let's say the stock you shorted experiences a massive hype cycle.
Which happens all the time.
Yeah, constantly. And the price rises by 50% against you. The shares you originally sold for $100,000 will now cost $150,000 to buy back.
So you are now down $50,000 on the trade. Your entire initial cash collateral is gone. You have suffered a 100% loss of your invested capital, but the position is still open.
That's terrifying.
It gets worse. If the stock pushes to a 60% or 70% gain against you, you enter the territory of negative equity.
Meaning you owe money you don't even have.
You literally owe the broker money that does not exist in your account. You've become an unsecured debtor to your brokerage firm.
Which triggers the dreaded margin call.
Immediately. The broker isn't going to sit around hoping the stock comes back down so you can pay them back. They're managing their own institutional risk.
They don't care about your thesis?
Not at all. They will forcefully step into your account, liquidate the position by buying the shares back at the current inflated market price, lock in your catastrophic loss, and demand you wire funds to cover the negative balance.
It completely removes your agency as an investor.
100%. You could have the most brilliant fundamental thesis in the world. You could have a 100-page dossier proving a company is fundamentally worthless.
But if the market remains irrational long enough to trigger that margin call,
your thesis is irrelevant. You are wiped out before reality ever has a chance to catch up with the valuation.
Okay, let me ask a pushback question here, because this is where value investors often get trapped, right?
Oh, absolutely. What's the pushback?
Well, let's say an investor looks at a company trading at 100 times earnings, declining revenues, massive debt. The fundamentals clearly scream overvalued.
A classic zombie company.
Exactly. The instinct is to say, I have the data, the market is wrong, shorting this is just a waiting game. Eventually, the fundamentals have to matter.
Right. And the fatal flaw in that logic is treating overvaluation as a catalyst.
What do you mean by that?
Overvaluation is simply a state of being. A stock can remain objectively absurdly overvalued for months or even years.
Valuation inertia.
Yes, valuation inertia. And during that extended period of irrationality, the short seller is subjected to what Carvalho identifies as the operational fragility of the trade.
Negative carry.
Exactly. Negative carry fundamentally destroys the concept of waiting out the market.
Because holding a short position isn't free. When you buy and hold a regular stock, time is your greatest asset. You benefit from compounding growth, and you can just hold it in your account indefinitely for practically zero cost.
Right. But holding a short position is an active daily bleed of capital. You are essentially renting those shares from a lender, and rent must be paid.
Via borrow fees.
Yes. Your broker charges you an annualized borrow fee, which accrues daily. The source material categorizes stocks into easy to borrow, or ETB, and hard to borrow, or HDD.
Okay, so if it's a massive, highly liquid company like, say, Microsoft trading normally, the borrow fee might be negligible, right?
Very low, a fraction of a percent.
But the stocks that retail investors are most tempted to short are rarely trading normally.
Exactly. They are usually the stocks exhibiting massive late-cycle euphoria. They're making parabolic moves that defy gravity,
So everybody wants to short them at the same time.
which dries up the available pool of shares to borrow. Scarcity drives up the price of the borrow.
And that's when a stock enters HTB territory.
Hard to borrow. The lenders recognize the demand and hike the fees astronomically. We are talking about borrow fees jumping to 30%, 50%, or in extreme cases of market mania, 1,000% annualized.
Wait, 1,000% annualized. That math is staggering.
It's brutal. At 1,000%, you are losing almost 3% of your total position value every single day just to keep the trade open.
Wow.
Even at a 50% borrow fee, the time decay is so aggressive that if the stock simply trades flat for a few months, if it does absolutely nothing, you will suffer a massive double-digit percentage loss strictly from the fees.
So time literally transforms into a hostile force.
It's your worst enemy. The underlying stock must drop significantly, and it must drop immediately just to outpace the daily accrual of borrow fees.
You're not just betting the stock will go down, you're betting it'll go down faster than your capital is hemorrhaging.
Exactly. And on top of that, we have to factor in the dividend leakage.
Right, the payment in lieu of dividends. This is such an operational headache.
It really is. When you borrow a share and sell it, the original owner of that share still expects to receive their quarterly dividend.
But since you sold the actual share into the market, the company isn't paying them anymore.
So the obligation falls entirely on you, the short seller. On the dividend X date, the broker reaches directly into your cash balance and withdraws the dividend amount to pay the original lender.
Out of your own pocket.
It is a mandatory out-of-pocket cash expense that actively reduces your available margin collateral.
Bringing you one step closer to that devastating margin call.
Exactly. You are fighting on three distinct fronts simultaneously. The theoretical risk of infinite upside, the daily compounding bleed of borrow fees, and the mandatory cash outflow of dividend payments.
The entire architecture of the trade is just structurally hostile to the investor.
It is. And to truly conceptualize how this hostile architecture destroys capital in the real world, Carvalho's TIV model provides a post-mortem analysis of two specific trades.
Okay, let's look at this.
The first is a classic example of what institutional desks call a widowmaker trade, focusing on Oracle, ticker symbol ORCL.
The Oracle case study is fascinating because it proves that you can be completely correct about the macroeconomic cycle and still lose all of your money.
It's the ultimate tragic irony in trading.
According to the source material, the TIV model using historical price action and quantitative cycle analysis identified the exact terminal peak of Oracle's cycle, which we'll define shortly as the end of Wave 5.
Right. And the model calculated that peak at exactly $203.90.
So let's trace the anatomy of a hypothetical short position initiated at that absolute cycle peak of $203.90 in June 2025.
By initiating the short at the fundamental top, the investor has perfectly timed the end of the long-term trend.
And if we jump ahead to the end of the story, Oracle eventually experienced a massive cyclical correction. It crashed all the way down to $155.11.
So it's a 54% drop from the absolute peak.
Right. So on paper, it looks like the perfect trade. You short the top, the stock collapses, and you close the position for a massive profit.
But Carvalho emphasizes the journey, not just the destination.
The journey is where the market's temporary irrationality breaks the short seller.
Exactly. Because after Oracle hit its fundamental cycle peak of $203.90, the the broader market entered a period of extreme narrative-driven euphoria.
The AI infrastructure pivot.
Yes, and this had nothing to do with Oracle's intrinsic valuation. It was pure, unadulterated speculative mania.
That AI hype acted as an artificial accelerant, pushing Oracle's price completely off its historical moorings. Instead of correcting downward from the $203.90 peak, the stock went parabolic.
It surged to an incredible $346 by September 2025.
Oh man, let's run the margin math on that violent upward spike.
It's ugly. From the entry point of $203.90, the stock surged 69.7% against the short seller.
And if you are operating on standard regulation, T50% initial margin.
That near 70% adverse price movement equates to a loss of roughly 139% of your initial cash deposit.
Wow, your original collateral is completely incinerated?
Yep. You are in deep negative equity, owing the broker nearly half the value of your initial investment again, entirely out of pocket.
And like we said earlier, the broker's algorithms don't care about your belief that the AI hype is a temporary bubble.
No, they don't care that the TIV model says the stock is structurally exhausted. The algorithms only see the negative equity. They issue the margin call and forcefully liquidate your entire position near that $346 peak.
You are forcibly ejected from the market, locking in a catastrophic portfolio-destroying loss.
And the most agonizing part of the Widowmaker trade is what happens next.
Right. Months later, the AI hype evaporates, reality reasserts itself, and the stock crashes to $155.11.
You were fundamentally right. The cycle was over at $203.90. But because you chose to express that view through a short position, the temporary irrationality of the market bankrupted you before you could be proven right.
It perfectly illustrates that famous market adage, right? The market can remain irrational far longer than you can remain solvent.
Exactly. Identifying the end of a cycle is a brilliant analytical achievement. But utilizing that information to open a short position exposes you to variables you cannot control.
Like sentiment, hype, and liquidity-driven short squeezes.
Right.
Here's where it gets really interesting, though. Because the pushback here is obvious. Oracle was caught in an AI bubble, which is a rare generational hype cycle.
Sure.
What if you target a boring, stable company? A company completely divorced from Silicon Valley mania?
This brings us to the second case study Carvalho presents. Aon plc, ticker AON, a global professional services and risk management firm.
Right. There is no AI euphoria driving Aon.
No, none. The Aon case study is perhaps even more instructive because it removes the extreme volatility of a hype bubble and focuses purely on the insidious nature of negative carry and opportunity costs.
So the TIV model identified Aon entering a structural corrective phase. A short was initiated on February 25, 2025, at a price of $396.38.
And unlike the Oracle disaster, the Aon trade played out beautifully on the chart. Over the next 13 months, the stock steadily depreciated, eventually hitting $321.41 in March 2026.
No violent spikes, no margin calls, just a clean, predictable drop yielding a gross profit of $74.97 per share.
By any standard metric, generating a $74 gross profit per share is a massive win.
Absolutely.
But Carvalho forces us to look at the net reality of the trade, factoring in the operational friction we discussed earlier.
The leakage.
Right. Over that 13-month holding period, Aon distributed 4 quarterly dividends. As the short seller, you were legally obligated to pay those dividends out of pocket.
Which amounted to a cash drain of $2.98 per share.
And even though Aon is a massive, liquid, easy-to-borrow stock, there is still a continuous cost for borrowing the shares. Over the life of the trade, those ET&Me borrow fees ate up roughly $9.15 per share.
So when you combine the dividend leakage and the borrow fees, you have over $4 per share in fixed operational costs.
Eroding roughly 5.5% of your total gross profit. The friction of the trade constantly chips away at your alpha.
And the concept of alpha is critical here. Generating alpha means you have utilized your specific analytical skill to produce a return that is entirely independent of the broader market's performance.
Which is exactly what this was. The Aon short was incredible alpha. You identified a specific asset that lost nearly 20% of its value while the macroeconomic environment was doing something completely different.
But the critical comparative metric here is the tape, right?
Yes. The general passive direction of the broader market, typically represented by the S&P 500 index.
While our short seller was meticulously monitoring the Aon position, paying out dividends, absorbing borrow fees, carrying the theoretical risk of infinite loss, what was the tape doing?
According to the data, during that exact 13-month window from February 2025 to March 2026, the S&P 500 generated a total return, including its own dividend payouts, of 19.81%.
The broader market went up nearly 20%.
And this is the devastating punchline of the Aon case study. You spent over a year managing a highly complex, operationally fragile short position, fighting against the structural upward bias of the market,
just to achieve a net return that was virtually identical to and on an unleveraged basis, slightly worse than simply buying a passive S&P 500 index fund and walking away.
Exactly. It demands a massive reassessment of risk versus reward.
Why voluntarily subject your capital to margin requirements, dividend liabilities, and unlimited upside risk just to fight the PAPE, when the 10.5% historical gravity of human progress was offering you the same return for practically zero effort and strictly defined risk?
You really have to ask yourself that. It proves that shorting in a generally bullish macroeconomic environment requires the target stock to completely decouple from reality.
The stock has to collapse so violently and so rapidly that it overcomes both the operational costs of the short and the massive opportunity cost of not just being long the index.
It is an incredibly high hurdle for success, and one that most retail investors dramatically underestimate.
So if we connect this to the bigger picture, if shorting is fundamentally a mathematical trap, whether it destroys you via margin calls like Oracle or bleeds your opportunity costs like Aon, how do we actually utilize the insights of the TIV model?
Right, because we know a stock is peaking. We know a cycle is ending.
Exactly. What is the mechanism for actually identifying that peak, and what do we do with that information?
The mechanism Carvalho relies on is deeply rooted in quantitative cycle analysis, built around an explicit mantra. Watch the cycle, not the hype.
Watch the cycle, not the hype. I like that.
The fundamental problem with how retail investors operate is the reliance on subjective narrative. They consume financial news, read social media sentiment, and make emotional decisions based on fear of missing out, or FOMO.
The narrative is always heavily biased by recent price action, right? If a stock is going up, the news cycle invents 50 reasons why it will keep going up forever.
And if it's going down, the pundits declare the company is dead. It is entirely reactionary.
But Carvalho's TIV model strips away that subjective narrative entirely.
It does. It operates on the premise that all fundamental data, all human emotion, all greed, and all fear are ultimately aggregated into price and volume data.
So by analyzing the historical trajectory of an asset, the model maps out a rhythmic five-wave structure.
And this isn't just looking at a chart and guessing where a line might go. It is a mathematical framework for understanding the life cycle of capital accumulation.
Let's break down the architecture of this five-wave structure for the listeners. Because how does a quantitative model take decades of chaotic trading and organize it into predictable waves?
Well, the waves represent the psychological progression of market participants. The early waves, Wave 1 and Wave 2, typically represent the accumulation phase.
That's where the institutional smart money is building positions quietly.
Exactly. Based on deep fundamental analysis, while the broader market is largely ignoring the asset or even actively shoring it.
The quiet phase before the storm.
Yes. But as the underlying fundamentals start to manifest in earnings reports and visible growth, you transition into the core momentum phase, which is Wave 3.
And Wave 3 is historically the longest and most powerful phase of the cycle.
It is. This is where institutional momentum takes over. Hedge funds, mutual funds, and large-scale asset managers flood into the stock. The trend becomes undeniably clear, and the price action is aggressively upward.
It's the purest expression of the asset's intrinsic value being recognized by the market.
Right. And after that massive run, it is mathematically inevitable that the early institutional buyers will want to lock in profits, leading to the consolidation phase of Wave 4.
Where the price chops sideways or corrects slightly, shaking out the weak hands and resetting the technical indicator.
Exactly. But it is Wave 5 that we really need to focus on, because Wave 5 is where the retail investor usually gets trapped.
Wave 5 is the terminal phase of the cycle.
Structurally, it is driven less by underlying fundamentals and almost entirely by late-stage retail FOMO and narrative euphoria.
Because the fundamental thesis that drove Wave 3 has already played out.
Right. But the stock has been going up for so long that the general public assumes it will go up forever. They rush in, providing the final burst of liquidity.
And the five-wave model identifies wave 5 not by looking at the news, but by measuring the mathematical exhaustion of momentum.
Precisely. Even as the price makes new marginal highs, the underlying quantitative indicators like volume, relative strength, and momentum oscillators begin to diverge.
The model recognizes that the buying pressure is hollow. It's running on fumes.
Returning to our Oracle example, Carvalho's TIV model didn't just guess that $203.90 was the top.
It mapped a multi-decade accumulation cycle.
Yes. Measuring the exact amplitude and duration of the previous 4 waves and mathematically projected the terminal exhaustion point of wave 5. When the price hit $203.90 and the momentum indicators confirmed terminal divergence, the model declared the long-term cycle complete.
Understanding this structure highlights a massive philosophical difference between the TIV approach and the traditional financial advice handed out by, say, 401k managers.
Oh, totally. The dogmatic buy and hold forever strategy assumes that cycles don't matter as long as your time horizon is infinite.
But it's important to clarify that the TIV model deeply respects the power of long-term accumulation, right?
Very much so. The source material explicitly notes that if an investor bought Oracle at the beginning of its multi-decade cycle and held it through the entirety of the 5-wave structure, they would have achieved a staggering 2,472% return.
That is just incredible. A 2,400% return absolutely obliterates the S&P 500, which returned roughly 349% over that same historical window.
It really proves that holding a high-conviction asset through its primary growth phase is how generational wealth is created.
So, why not just hold it forever? Why does the TIV model care about the end of Wave 5?
Because the completion of Wave 5 guarantees a structural reset. Once a full 5-wave cycle is exhausted, the asset must undergo a massive, prolonged correction or a multi-year period of sideways consolidation.
To absorb all the capital that was misallocated during the late-stage euphoria.
Exactly. The traditional buy-and-hold investor is essentially instructed to ride the elevator all the way to the penthouse and then stubbornly stay inside the elevator as it plummets back to the lobby.
Watching decades of unrealized net worth simply evaporate, hoping the cycle eventually starts over. The psychological toll of that is devastating.
You watch a $1 million portfolio bleed down to $500,000 over 3 years, and your advisor just tells you to stay the course.
Yeah, the TIV model rejects that passive suffering. It advocates for strategic exits.
When the math dictates that Wave 5 is complete at $203.90, the objective is to say, thank you for the 2,400% return, and decisively step off the ride before the elevator cable snaps.
It elevates capital preservation to the absolute highest priority.
Recognizing the peak is about locking in your historical alpha, protecting the wealth you've generated, and refusing to participate in the inevitable, mathematically certain destruction of capital that follows terminal exhaustion.
Okay, this brings us to the operational reality for the listener. The retail investor who is analyzing their own portfolio today, they understand the geometry of loss. They know that shorting is an operationally toxic, mathematically skewed trap. They understand how the TIV model utilizes the 5-wave structure to identify terminal exhaustion without human bias.
And they realize that one of their core holdings has just printed a massive euphoric Wave 5 peak.
Exactly. So what is the actual practical step for them? What is the mechanical playbook for that investor tomorrow morning?
The playbook begins with Carvalho's most explicit, inflexible directive: I don't short stocks, period.
The entire premise of the TIV model is built around identifying cycle peaks for the purpose of capital preservation, not for aggressive bearish speculation.
Correct. Now, we should address the single, highly technical caveat to that rule, because the source material does acknowledge one extreme mathematical exception where shorting might be theoretically considered.
Right, there's a very specific structural anomaly known as an extended wave 3.
In standard Elliott wave theory and the TIV framework, wave 3 is the strongest, but an extended wave 3 consumes an unnatural amount of the cycle's total momentum and capital.
It stretches far beyond standard Fibonacci projections.
Yes. So if wave 3 consumes all the oxygen in the room, what happens to wave 5?
It structurally starves the final wave.
Exactly. A terminal cycle featuring an extended wave 3 often results in a truncated or deeply exhausted wave 5. The buying power is so thoroughly depleted that the mathematical risk of the stock experiencing a massive post-peak irrational surge like the Oracle AI bubble is severely diminished.
And Carvalho details the exact granular mathematical parameters required to identify this rare setup on pages 34 and 84 of his book, Technical Intrinsic Value.
But the operative word there is rare. Unless an investor is a seasoned quantitative analyst who has mastered the deeply complex geometry of wave extension and truncation, that exception does not apply to them.
Right. For the vast majority of retail investors, the golden rule remains absolute. You do not short.
If shorting is off the table, the strategic imperative becomes defensive capital allocation.
It sounds simple, but it is psychologically the most difficult discipline for a retail investor to master.
Oh, absolutely. When your asset hits the wave 5 peak, you execute a sell order. You close the long position entirely, you realize the profits, transfer the capital to your cash sweep account, and then you do nothing.
The concept of doing nothing is anathema to the modern financial culture.
It really is.
We are conditioned to view cash as a wasted asset, a drag on the portfolio that is constantly being eaten by inflation. The pressure is always to deploy, to be active, to find the next play immediately.
That hyperactive conditioning is exactly how investors get chopped to pieces in post-peak volatility. As we saw with Oracle, the completion of Wave 5 does not mean the stock will cleanly and immediately drop.
No, the market can thrash violently for months.
It can spike 70% on a fake narrative before it finally collapses. If you sell your position but then try to aggressively trade the volatility, buying the first dip, getting stopped out, trying to short the bounce, you will systematically incinerate the massive profits you just locked in.
The discipline required to step aside and watch a stock you just sold surge another 20% on pure hype without feeling FOMO, without rushing back in to buy the top, is immense.
You have to trust the mathematics of exhaustion over the optics of price action. This is exactly why Carvalho frames cash not as a lack of investment, but as an active strategic position.
Cash provides you with the ultimate luxury in financial markets: optionality.
While the euphoric masses are fighting over the scraps of a dying Wave 5, absorbing the volatility and the eventual crash, you are sitting safely on the sidelines with your capital fully preserved and ready to deploy.
And deployment doesn't mean jumping back into the same exhausted asset. It means rotating your capital into entirely new structural opportunities.
This is the true power of macroeconomic cycle analysis. Not every stock is experiencing Wave 5 at the same time.
The market is an ecosystem of asynchronous cycles.
Exactly. While a massive tech conglomerate might be hitting terminal exhaustion in Wave 5, there is a quiet, ignored industrial sector or an emerging market asset that is just beginning to form the base of Wave 1 or Wave 2.
These early-stage setups offer incredible asymmetric upside with strictly defined risk parameters. It's essentially the financial equivalent of agricultural crop rotation.
That's a perfect way to look at it.
Right.
Yeah.
The farmer doesn't keep planting the exact same crop in the exact same field year after year until the soil is completely dead and yields collapse. They harvest the peak yield, and then they leave that field fallow to recover its nutrients.
They rotate their seeds to a fresh, fertile field that is ready to support a new cycle of aggressive growth.
Defensive capital allocation is just crop rotation for your portfolio.
You harvest the massive yields of a completed 5-wave cycle. You let that specific asset go fallow, allowing it to endure its multi-year correction and consolidation phase without your money trapped inside it.
And you plant your preserved capital into the fertile ground of a newly developing Wave 1 accumulation phase. It is an incredibly elegant way to approach portfolio management.
It really is. It removes the anxiety of trying to predict daily price movements and replaces it with a calm, mathematically sound, structural overview.
We have unpacked a tremendous amount of complex architecture today, and it is vital to synthesize how these disparate pieces form Carvalho's cohesive philosophy.
Well, we started by dismantling the romanticized myth of the short seller. We looked at the hard, unforgiving geometry of the trade, how a maximum 100% gain is leveraged against the terrifying reality of infinite loss.
We exposed the hidden operational plumbing, the astronomical borrow fees of hard-to-borrow assets, the daily compounding decay of negative carry, and the out-of-pocket drain of dividend obligations.
And we saw how those hostile mechanics actively destroyed our hypothetical Oracle investor, triggering a catastrophic margin call during a temporary AI hype bubble, entirely wiping out their portfolio before their fundamentally correct macroeconomic thesis could even play out.
Not to mention the Aon case study, which proves that even when a short trade works perfectly, the operational friction often results in underperforming the simplest, most passive S&P 500 index strategy.
The antidote to that operational fragility is the quantitative discipline of the TIV model. By utilizing historical data to map the progression of human psychology into a rigid 5-wave structure, investors can strip away the noise of the financial media.
They can identify the exact mathematical moment of terminal exhaustion, the wave 5 peak, not as an invitation to short the market, but as a definitive signal to protect their wealth.
The goal isn't to fight the 10.5% historical gravity of human progress.
No. The goal is to ride that wave for as long as it is mathematically viable, step off with your capital intact before it crashes onto the shore, and calmly paddle back out to catch the beginning of the next wave.
Absolutely. And before we conclude, it is essential to reiterate one final time that the sophisticated market mechanics, the quantitative five-wave cycle analysis, and the broader portfolio management philosophies we have explored today are the exclusive proprietary work of Nicolau Primavera Carvalho.
As the author and creator of the TIV model, his analytical frameworks offer a profound alternative to the chaotic, narrative-driven trading that traps so many retail investors. His work provides a blueprint for sanity in an inherently irrational environment.
It does.
And as we leave you to analyze your own portfolios today, I want to leave you with a philosophical shift to ponder. The modern financial ecosystem is a massive machine designed to extract your attention and your capital through constant stimulation.
Your phone is buzzing with breaking news alerts.
The financial networks are screaming at you to buy the dip, short the peak, trade the earnings report, rotate sectors. The overwhelming message is that you must constantly be in motion to succeed.
It creates an illusion that activity equates to alpha.
Exactly. But if the underlying mathematics of the geometry of loss and the five-wave structure teach us anything, it is that forced activity at the wrong moment in a cycle is the primary destroyer of generational wealth.
So,
What if the most sophisticated, mathematically superior investment decision you can possibly make at the peak of market euphoria is the conscious choice to simply walk away,
the profound discipline of intentional inaction.
choosing to hold your cash, turn off the screens, ignore the noise, and comfortably allow the market to exhaust itself and burn through its terminal volatility completely without you?
It is the ultimate expression of control in an uncontrollable system.
We hope this deep dive has given you the tools to reclaim that control. Until next time, keep exploring those depths.
That's it for today. I'll see you in the next episode. The Technical Intrinsic Value Podcast is a systematic exploitation to enhance data analysis and delivery. All content logics provided herein are a direct reflection of the opinions value modeled Nicolau Primavera Carvalho. The information provided is for educational and informational purpose only and does not constitute financial, investment, or legal advice. The TIV model is a framework designed to identify patterns based on 15 years of future results. All investments involve risk. By continuing, you acknowledge you are a self-reliant investor responsible for your own execution.